Welcome to our webinar on scaling solar in low-income communities with the Inflation Reduction Act. Thanks for joining us. My name is Stephen Abbott. I'm a principal here on RMI's US program and was the lead author of the report that we'll be discussing today. During the webinar, please feel free to submit questions via the Q&A function on your screen, and we'll get to as many as we can during a live Q&A session at the end of the webinar. For those of you viewing this as a recording, please reach out to our team if you have any questions. The relevant contact information is provided on the last slide of this presentation. Finally, RMI would like to thank JPMorgan Chase for the funding that enabled this event and research. I'd like to start by providing a quick agenda for our time today. I'm going to begin by providing a brief summary of RMI's paper on the financial model that we will be discussing today. That will run for roughly the first third of the meeting, after which we will transition to an expert panel and be able to speak to some of the pioneers who have been working to stand up and pilot this model in various parts of the country. And then we will finally transition to an open Q&A session. And once again, you are all invited to submit questions throughout the event, and we will get to as many as we can at the end. So to set the stage, I want to just note the fact that low-income communities have not proportionally benefited from the cost savings that solar PV can provide in many parts of the country. And as one statistics notes, in 2022, the median income of rooftop solar adopters was almost twice that of the broader population. There are many reasons behind this lack of adoption among low-income communities, and NREL has provided some great resources and research on that topic. But I want to focus on a couple of financial issues that low-income households often face. The first is that rooftop solar or even community solar can require high upfront costs that inhibit direct purchases. Many low-income households simply do not have the thousands of dollars necessary to make a direct investment themselves. This issue is made worse by the fact that the federal tax incentives are structured in such a way that they offer a credit against annual federal tax bills. However, many low-income households do not have any or do not have sufficient annual federal tax bills to be able to fully leverage this credit, meaning that they are missing out on some important incentives and have difficulty monetizing those credits directly. Third is the fact that many low-income households also do not have high credit scores or high FICO scores, and as a result, find it difficult to access low-cost financing. The combination of these three factors, among many others, makes it difficult for low-income households to adopt solar, which means that many of them are stuck with higher energy costs than they might be able to enjoy if they were able to adopt clean energy like rooftop solar or community solar. And this leads to it is a contributing factor to the fact that the national average energy burden for low-income households, meaning the percent of their income that goes towards paying their energy bills, is 3 times higher than that for non-low-income households. And that's from the DOE. But the good news is that the Inflation Reduction Act provides tax-exempt entities with means to address these challenges, because many tax-exempt entities have been suffering from similar sets of challenges. They also do not have tax bills, and in some cases may have difficulty accessing low-cost credit. This is not immediately going to be relevant to low-income households, but on the next slide, I will explain how we think we can leverage these opportunities to serve low-income households. So on the first issue, high upfront costs, the IRA, or the Inflation Reduction Act, included as part of the investment tax credit a variety of bonus adders, some of which are explicitly designed to incentivize projects in low-income communities or in energy communities. Going to the lack of a tax bill, elective pay, or also known as direct pay, is a new mechanism by which tax-exempt entities such as nonprofits, local governments, and others can receive the ITC as a cash payment instead of as a credit against a tax bill. And finally, looking at the issue around low credit scores, in addition to many other opportunities, the upcoming Greenhouse Gas Reduction Fund programs are in large part designed to provide sources of low-cost capital and other means of financial support to directly enable the adoption of clean energy technologies by low-income households. So now I want to describe a way in which these three programs could collectively enable a new model in which tax-exempt organizations serve as third-party owners for solar assets in order to help households, small businesses, and nonprofits leverage these programs. This would start with a tax-exempt owner, and that entity, be it a CDFI or a green bank or a local nonprofit, could start by engaging the local community to establish trust and design a program that's going to meet the local community's particular needs. They could then follow something along the lines of a solarized model, where as a central entity, they go out to the market, select solar developers, negotiate bulk rates, and pay the upfront costs for local solar developers to be able to install solar on rooftops or community solar projects within the community. Those local solar developers would then go ahead and install the solar and or storage systems and may be retained to provide ongoing O&M or operations and maintenance services during the lifetime of the projects. The local communities would then pay a small monthly lease payment to the owner and enjoy immediate savings as a result of having their utility bills significantly lowered. And finally, the tax-exempt owner would be able to collect the tax credits for each of these projects via direct pay and recoup up to 70% of the system costs. Now, we think that this is a powerful model in some situations because it can unlock significant value for homeowners. And to illustrate this, as part of our report, we developed we leveraged one of our existing models, the Green Upgrade Calculator, which you can find at greenup.rmi.org, to run the numbers on several different types of financial structures. And for this illustrative example, we focused on a low-income household in Nevada, and we assumed that they have zero federal tax burden each year. We also assumed that the rooftop solar system lasts for 20 years, which is fairly conservative. So in the first structure, the direct ownership, we assumed that this household took out a loan. And in that case, over the 20-year period, we found that the household benefited from roughly $10,000 in savings. We then shifted to a lease model, assuming anywhere between a 30 to 60% ITC payment. And in that context, layering in the federal tax incentives, the 20-year savings grew to somewhere between $12,000 to $18,000. And you may note that here we're using 60% as the cap, whereas on the prior slide, I mentioned that the ITC could potentially go up to 70%. And the reason for that is in the short term, we think it's unlikely that many of these entities would be able to access one of the bonus adders related to domestic content. And I'll talk more about that later. So, but for the purposes of our analysis, we left out that 10% bonus adder. Finally, in our third version, which we think is most relevant to this model, we again used a lease structure with the ITC, but we also assumed that through a combination of funds from the Greenhouse Gas Reduction Fund and or as a result of the fact that these are tax-exempt, perhaps mission-oriented organizations that are providing the lease, they were able to reduce the overall required rate of return on the project compared to what a commercial solar developer might require. So shifting that required rate of return down to something closer to 8% let us further grow the 20-year savings for the household up to somewhere between $16,000 to $20,000. Now, the specifics will vary significantly across different utilities, across different geographies, etc. But the point we wanted to illustrate is, in this situation, we think that this model could potentially double the 20-year savings for this particular household. And in the context of an LMI household, an extra $10,000 over 20 years is a relatively significant benefit to their financial situation. Another exciting piece of this model is that we think it's applicable or could be utilized by many different types of tax-exempt organizations. We started with the assumption that this would be largely adopted by nonprofit financial institutions, such as community development financial institutions, or CDFIs, or green banks. These types of entities have a range of advantages insofar as they tend to be relatively aware of local community needs. They often have strong community ties, or in the case of green banks, they're very familiar with clean energy technologies, and pursuing this type of model may align well with their overall mission and goals. However, we also have been working with several government institutions to explore if they might be interested in pursuing this model. And that could include tribal governments, local municipal governments, county authorities, or even municipal utilities. This could also be adopted by nonprofit utilities, such as electric cooperatives, who also have the advantage of having a relationship with many of the customers that may adopt this type of model or benefit from it. And there are certainly other types of 501c3 organizations out there who could adopt something like this. One could consider this as being an option for entities that own and manage lots of housing assets, either single-family homes for low-income households or perhaps multifamily homes. We also want to be upfront and transparent about the fact that this approach can also introduce new process challenges and regulatory complications, and these will need to be thought through and addressed by any entity pursuing this model. On the process side, given that this is a relatively new type of structure, many entities undertaking it will need to create new contracts and engage either their internal legal counsel or external counsel to understand exactly what they are signing up for. Next, many of the entities I just described, such as CDFIs or in some cases electric cooperatives, may not have expertise within their organization about developing solar projects. And thus, they may need to acquire that expertise in some fashion in order to properly deploy this model. Moving to a lease structure may also require the development of new tools and software, given that many CDFIs are more focused on traditional loans as opposed to leases. There's also the issue that as an owner of the project, these entities may be exposed to some level of liability regarding their performance or any damage associated with their operation. And finally, again, coming back to the fact that this is a new model, there is the need for lots of market education. Really, all of the stakeholders, ranging from investors, local entities who would benefit from this setup or host sites, they all need to be educated about what they are signing up for and in a way that they will trust in the process and understand the benefits that they will receive. Next, there are also a variety of regulatory complications that might arise for some entities. For any CDFIs undertaking this process, they should be aware of the fact that CDFI guidelines require that a predominance of CDFI activities are focused on lending, and leases as of right now do not qualify as loans. There are ways to address this, but it's an issue that would need to be managed. To the extent that anyone adopting this model plans to leverage GGRF funds, they may need to consider the implications of Davis-Bacon Act. This is a complicated topic, but in short, Davis-Bacon requires that contractors doing the work that are paid for through various programs are paid a prevailing wage, and that the firms report those wages on a regular basis. This is well understood and done in many industries already, but for groups like small residential solar contractors, they are not used to satisfying these types of requirements, and thus there will be a learning curve associated with that. Third is the direct pay application. The complication here is that direct pay is still a relatively new mechanism, and there is a lot of work to be done to help different entities understand how to access credits like the ITC via direct pay. The good news is that there is a whole network of nonprofits, and many of our peers have done great work providing and designing resources around direct pay. And I particularly want to call out Lawyers for Good Government as having an excellent portal that I would recommend to anyone pursuing a direct pay application. Fourth is domestic content, and I mentioned this a few slides ago. For commercial entities that are pursuing solar and going to use the ITC, domestic content is purely a bonus adder. If you use enough domestically sourced materials or components, you're eligible for a 10% adder to the ITC payment. However, for anyone planning to use the ITC via elective pay or direct pay, domestic content actually can impose significant haircuts on the ITC if the requirements are not met, particularly after a couple of years in the future. There is an exemption, and this is important for this model, for any project under the size of 1 megawatt. However, there are also rules around when, for IRS purposes, projects need to be aggregated and considered fundamentally one project. So any entity seeking to avoid the domestic content haircut by only pursuing projects below 1 megawatt needs to make sure that they are not triggering aggregation unintentionally. And finally, excess benefit is more of a cap on the overall ITC payment. At its core, it seeks to ensure that entities are not paid through one means or another from government sources more money than the project cost. And it can also impose a haircut to the ITC payment if tax-exempt bonds are used as part of the capital stack. I also want to note a few ways that we identified in which GGRF awardees and other partners can support and enhance this model. The first is they can reduce risk for the tax-exempt owners. NCIF or CCIA awardees could consider developing programs that help insure project owners against liability, or thinking about the possibility of default. These entities could also provide credit enhancement support, perhaps in the form of loan loss reserve funds or subordinated debt. And both of those have been used in solar lease programs in the past by the Connecticut Green Bank and others. There's also an opportunity to develop and distribute standards and education. I mentioned several challenges around just the fact that this is a new type of model and there are requirements for new contracts and education. So developing and distributing standardized tools and templates is one important activity that our overall community can seek to pursue in order to reduce those costs. There's also an opportunity to reach out and engage and educate private financial institutions to make them more excited about investing in these types of models. And third, investors can support the model directly. This could be done either by providing additional low-cost capital, and we did identify the New Markets Tax Credit, program-related investments from philanthropic organizations, or the Community Reinvestment Act as potential means to access additional low-cost capital. There's also an emerging idea around establishing a centralized platform to own these projects. The model that I described at the beginning of the presentation assumed a relatively local entity was playing the role of an asset owner, but there's no particular reason that we have identified that that role could not be played by a more national or regional organization who could specialize in this model and the intricacies of the ITC and the various regulatory challenges. I will not read all of the names here, but I wanted to quickly note that this paper simply could not have been written without the support of many, many individuals and organizations. And I wanted to express my deep thanks to all of these people for their contributions to helping us understand the model and be able to provide as much guidance on deploying it as we can today. Finally, my last slide before moving on to the panelists. I wanted to just note that RMI is continuing to pursue this model. We are fortunate to have funding from the Leon Lowenstein Foundation to collaborate with 11 communities across the country who are seeking to pilot this exact type of structure. If you're interested in learning more about that effort, please feel free to reach out to me or my colleagues. And again, we'll share our contact information at the end of the presentation or at the end of the webinar. With that, I want to open things up for our panel. And I want to quickly introduce our panelists, although I will also let them introduce themselves. I am very excited to have three real pioneers in this space with me on the line today. First is Lynn Heller, the founder and chief executive officer of the Climate Access Fund. Second, Roger Horowitz, the director of Go Solar programs at Solar United Neighbors. And finally, Andy Posner, founder and chief executive officer at Capital Good Fund. All of these individuals have done remarkable things to pilot this model, and I'm really excited that they are here today to share their insights. All right, I'm going to close this here and open it up for our panel. So first question for our panelists, and Roger, I think I'd like to start with you. Um, could you share a bit about how you have been integrating this type of third-party ownership structure into your program to date?
Yeah, absolutely. Thanks for having me today, Steve, and everyone from RMI. So our first project that we've done with this was in Duluth, Minnesota. So Solar United Neighbors, we operate all over the country and have on-the-ground programs in 13 states, plus DC and Puerto Rico. So our Minnesota team has been working with a land trust that owns the land under the homes there, and they already have a great relationship with all of the homeowners who own the homes on top of the land. So the land trust was really interested in doing a pilot for this model to be able to use the elective pay feature. So that we did earlier last year, actually, we did this pilot program with them and figured out as Andy has done with the Capital Good Fund and with a lot of other folks, just how much work it's been to get all these documents together. So as we were working on this project, we realized that even though Solar United Neighbors is not a CDFI, not a green bank, and we're never going to be doing a large volume of this, we're really interested in making sure that other folks have the ability to do this and helping get these pilot projects off the ground. So our first pilot project that we launched in Duluth was successful. A lot of the work has been legal work, getting all the papers together, getting all the forms together. And a lot of it really has been trial and error for us, but it's been a great learning experience. And we've gotten a case study together. And then in the very near future, we'll have all of our documents that were approved by legal folks together so we can share that with all of the partners out there so that everyone will be able to take advantage of all the work that's already been done and have these templates ready to go so that they can do this in their own communities.
Excellent, thank you. Lynn, maybe I'll turn it over to you. Same question.
Sure. Yeah. Well, first of all, thanks so much for having me and the Climate Access Fund. So just a quick word about the Climate Access Fund. We are a green bank. We're a nonprofit green bank that was not started by an arm of government at any jurisdictional level. We essentially do two things. We're all about filling financing gaps in the low-income community solar market in Maryland. So we have a fairly narrow niche. Because we're about filling gaps, we do that in two ways. One is sort of your more typical green bank financing of low-income community solar projects that are owned by other entities. But we also noticed one of the gaps where I should say commercial financing alone doesn't allow them to serve as many low-income households in Maryland, given the economics and the regulations in Maryland as they would like. But then we also noticed a gap that that project economics don't really allow for many for-profit developers to develop smaller below 1 megawatt projects that are really community focused and are located in historically disinvested communities. And it's that piece of what we do that that is the sort of topic for today. We have a demonstration project in East Baltimore on a public charter school. It's a K-8 school. It's called Solar for Us at Henderson Hopkins. It's an 800 kilowatt system. It's 100% LMI community solar offtake. So that's about 150 households. We offer the households a 25% discount on their electricity bills. We also offer educational, job training, energy efficiency, and shared ownership benefits. And I'm happy to talk about any of those in the Q&A if anybody's particularly interested, but it's part of our kind of comprehensive approach to community solar. This project, the Climate Access Fund as a nonprofit green bank is the owner of the system. Through direct pay, we have applied for the 20% low-income communities bonus tax credit. Hopefully we will get that. We believe we can get the domestic content adder as well. But we've raised the rest of the funding through various private sources because this was before the days of of the greenhouse gas reduction fund and the low cost financing that we hope to get with that. We raised the capital through the debt capital through philanthropic PRIs, through crowdfunding, actually, and through a high net worth individual. We also have an SREC prepayment contract signed with a private company that is paying for our SRECs in advance at a premium to help us cover some of the social mission costs. So there are we sort of intentionally came up with a bunch of different innovative financing mechanisms, kind of a menu that we want to share with other folks of things that have worked in addition to greenhouse gas reduction funds, because these smaller projects in historically disinvested communities really need kind of a little bit of everything to make the project economics work. We are looking to replicate this demonstration project model around the state with Solar for All money. The low-cost financing, actually the enabling improvement funding that's included in Solar for All is going to be really critical, because it's going to allow us to work with host sites that may be nonprofits that need new roofs, so we can contribute to roof replacement. And then when you combine Solar for All with direct pay and hopefully the bonus ITC, and then some of this private capital from the sort of menu of options that we've come up with, that's what allows for the project economics to work. So I will stop there. Look forward to the questions and answers.
Thanks, Lynn. Andy, over to you.
Thank you. Hello, everyone. Really excited to have this conversation. I hope that I'm not disrupted by another earthquake. I live in Los Angeles and we just had one. So if things start shaking, that's why. But I'm Andy Posner. I'm the founder and CEO of Capital Good Fund. We are a nonprofit CDFI based in Rhode Island. We've been around for 15 years. And just a quick backstory on how we got into our solar leasing program. We've been doing heat pump loans and other types of loans for 15 years, but it wasn't until 2021 that we felt ready to launch a solar lending business. And what we learned through that is that going from any type of lending to solar lending is easy, but it's very difficult to make it work for low-income households. When I say easy, I mean like the infrastructure of a loan product going from, say, business loans to solar. But the lack of refundability of the consumer tax credit was a major barrier, as Steve highlighted in the report makes clear. So when we saw direct pay and IRA, immediately started working towards building that model. And after about a year and a quarter of work, we launched what we call Georgia Bright on a pilot basis in Georgia. Not because it's easy, but because my joke is, but because we thought it would be easy. Georgia is a very difficult market for solar, but it's very much where we are meant to exist, because as a nonprofit, we are here to solve market failures. So the way that this works is that through a series of single member owned LLCs, and it's very important that they be single member owned, because you typically don't want to own solar assets on balance sheet for liability reasons and all sorts of reasons. But if you do it through an LLC, it has to daisy chain up to the tax-exempt entity that will claim the ITC. So these LLCs take out the debt to finance the system. They sign the agreement with the EPC or installer. They sign the lease agreement with the homeowner or the nonprofit entity. And when I say they, I mean, it's us really through that entity. And then that entity services the lease or PPA, services the asset, insures it, monetizes RECs, and the like. So in our pilot program, which undergirded our successful Solar for All grant, which I'll be talking about later, but we received $156 million from EPA to massively scale up. But the way the program works is available statewide. It's a no upfront cost lease with maintenance included. We're seeing about a 10 to 20% day one savings with solar only. And for customers that add a battery, it becomes a bill swap, if not a slight increase. It's in many ways, it's a typical lease. So 2.69% annual escalator, 25-year lease, as I said, no upfront cost. The reasons why we're able to make this work where no other lease companies really operate in Georgia is a couple things. First one is, in my opinion, unless you're doing a utility scale solar project, direct pay is the most cost-efficient way to monetize the tax credit. We don't have all the transaction costs and bites of the apple of a tax equity structure. With transferability, you're selling for 85 cents on the dollar, maybe 90, and you have a lot of legal costs. The only thing we don't get is accelerated depreciation, which matters at massive scale, but not at ours. We get concessionary debt as a nonprofit, getting PRI or CRA eligible dollars. And then we can leverage our ability to raise grants and donations to offset some of our operating costs that would otherwise have to be passed on to the customer in the lease payment. One of the things I'll note is that, as Steve mentioned, whereas going from one lending product to a solar lending product is fairly easy, launching a solar business was almost like starting Capital Good Fund over again. The legal structure is different. The servicing software we had to build from scratch. The way that you price leases is different. The contracts. We'd never done project finance, so the whole capital stack. There's all sorts of complications about how direct pay flows because it actually goes to the parent nonprofit, not to the LLC that owns the asset, and so on and so forth. So one of the things that we've seen is a number of states have been interested in us bringing our leasing model as think of it as direct pay as a service. So I will say, anybody that's interested in doing leasing, I am happy to give you everything that we've built if you want to build it yourself. It's probably a year to year and a half process. So if you don't want to do that, we are currently starting a business planning process to figure out how to work with local stakeholders who will do customer outreach and education, EPC recruitment and management, setting program design elements, and then passing it off to us once a customer is ready to get a lease quote, apply for the lease, and we would handle everything from there on the back end: insurance, monetizing the credit, servicing the asset, servicing the lease. So yeah, I'll leave it there, but I'm any way that I can support people with what we've learned, I'm happy to do.
Great, thank you. I think we have one question for each of you in addition, and then we'll turn it to the audience Q&A. So Roger, going back to you, one of the aspects that struck me about your approach was the ability to offer systems at no cost to the homeowners. So could you say a little bit more about how you were able to achieve that and if there were any particular challenges you came across in the process?
Yeah, thanks so much. At Sun, I think one thing that we've learned doing this for a long time is just how different the economics are in every state, in every utility area. Also, just in terms of the amount of sunlight. So I think when we realized that we were going to be piloting a program in northern Minnesota, just the economics of it, in order to have folks actually see meaningful savings, just it doesn't pencil out in the same way that we would like with the program based in Georgia or in Florida. So I think we've really learned that one size does not fit all for our programs. So we're lucky. We have a great development team and have been getting lots of grants to do this work. But our programs really do vary based on where we are. For example, our programs that we run in Denver, Colorado, the city says we're going to do give $8,000 per low and moderate income state installation per customer. And then for this Duluth project, we got entire funding, so everything is going to be free. And some places it's a lower interest rate depending on the lender and things like that. But that was really our key learning, is just that with the cost of utilities not being super high and with there being very little sunshine during the winter months in Minnesota, one goal that we've always had at Sun is really just to make sure that we're never increasing anyone's costs on a monthly basis. And that's really been one of the struggles in the northern US, is just that as opposed to Florida and Texas and Arizona and Southern California, which are getting a lot of solar production even during the winter, we've just realized that when we're working in places like Duluth, Minnesota, even if you have savings where, okay, the savings chart, they're going to be saving 20% over the time of year, we realize that those savings may actually be negative in December and January. So that's something that we've seen, and luckily we've been able to pass that message on to funders as well. That is really important for us to be able to make sure that folks are seeing some guaranteed savings every month of the year. So yeah, the answer for us is it really depends, but that's what worked out with this project.
Great, thank you. And Lynn, you mentioned already that Climate Access Fund is working to replicate its demonstration project as part of its Solar for All plans. Can you please describe some of the approaches you've taken to financing the project and how you're planning to use Solar for All to replicate this going forward?
Sure, yeah. As I mentioned with our demonstration project, we really sort of intentionally made it a little more difficult for ourselves because we wanted to push the envelope on financing. And again, this was not public financing. This was various forms of nonprofit, philanthropic and private financing. So we were intentionally taking the sort of harder path, but that is all to say that it's not the way we pulled together this project and financed it, and it is an unusually large project for a rooftop project in an urban area. But it's not particularly scalable without a substantial amount of low-cost public financing. Lo and behold, the Inflation Reduction passed in August of 2022, and there is Greenhouse Gas Reduction Fund capital on the financing side, and obviously direct pay and the bonus tax credits on the IRS side. And so that's really how we are going to, what that's going to do is allow us to do many more projects that are, again, small scale, relatively speaking. They serve at least 50% low-income households. They save now, talk about difference in jurisdictions. In Maryland, our next door neighbor, DC, has, I'm sure you all are familiar with, or many of you are familiar with their Solar for All program. Policy really matters. So all the developers like to work in DC. They don't love Maryland because the value of our SRECs is a lot lower than the value of the SRECs in DC. So it's a lot harder to make project economics work, particularly when you don't have the benefit of economies of scale. So Solar for All and the tax credit, all of the GGRF and IRA funding through the form of tax credits and low-cost financing is just critical to helping this market get off the ground. And by this market, I mean smaller projects that really do maximize benefits to low-income communities and to renters who can't put solar on their rooftops.
Great, thank you. Last question, Andy, as you mentioned, you received a Solar for All grant. Congratulations. What advice would you have for other recipients who are interested in pursuing this model, either directly or in partnership with other organizations?
Well, so the first thing is to figure out what is that financing structure. I mean, financing is not the only challenge. Once we got the legal structure in place and the capital in our pilot, where I should say we've done 70 contracts across residential leases and commercial PPAs. The hardest part has been customer acquisition. And if you go into any low-income community, and I'm sure Lynn and Roger know this quite well, they're going to all say, we have had someone knock on our door saying that you can get free solar. And there's a lot of trust building to do. And one of my concerns is that, we have a federally funded program. There's already people we're hearing in Georgia being sold solar claiming to be from Georgia Bright. So that trust building and education is really key. And then bringing on board the community groups that are kind of gatekeepers, so environmental justice advocates and others is really important. I will say also that we have gotten a lot of pushback on third-party ownership because, a lot of community. So here I'll differentiate between what homeowners say and what kind of community leaders will say. But from the community vantage point, there's a lot of concern about, well, is this building wealth? Is this extractive? And I hear that. But I really want to emphasize again, even if a homeowner can claim the tax credit, and I think that RMI had one data point in another report that said 70% of households can't claim any or all of it. That doesn't mean that they're going to use that tax credit to pay down their debt, their loan. And if you don't pay down the loan by the tax credit, you're still got a high loan payment because that tax credit isn't cash in hand. And then you don't get the energy community adder, you don't get the domestic content adder and the like. So the way that we incorporated that feedback is that we have a very generous buyout option. So starting in month 72, after the tax credit vesting period, we allow homeowners to buy out the system. And that price it's fair market value, but really what it is the balance on the debt, we took out the system plus $500, which usually is about 2/3 of the original system cost. But I think the thing we did do right was that we had a number of meetings up front with stakeholders, heard that feedback, heard feedback that batteries were really important, which we didn't think would be the case for low-income homeowners. And that resulted in two changes. One is that buyout option I mentioned. And the other one is, if you do batteries, you need to have a battery reserve fee so that you can replace the battery after the warranty period. And like I said, half of our customers have opted for storage, even when that results in a bill increase, because that's how much they value that backup if they're low income. So doing that upfront, it's no different than when a utility scale developer wants to build in a community and they don't do that community outreach right and they get all the pushback. Also engaging capital providers very early on in the process. It took us a year to close on our initial investments in the capital stack. Partly that was because direct pay guidance was coming out throughout the process, but part of it is just most investors are used to investing in tax equity structure, not in direct pay. They're not as comfortable with low income. And so you need to give yourselves time. And then I think engaging philanthropic partners, right? So you can get a lot of credit enhancement. You can, like I said earlier, offset some of your operating costs. Because one of the challenges is that if you do a 5 kilowatt system, the recommendation is that you have somewhere between $10 and $20 per installed kilowatt per year go for operations and maintenance. Well, on a 5 kilowatt system, $100 a year when your lease payment's only going to be 30 or 40 a month, like that, it doesn't work. So you have to kind of find some other way around that. And I'm happy to share a financial model we built that solves for that in some ways. But use the Solar for All dollars, use GGRF dollars, as Lynn was talking about, to get credit enhancement, to get grant dollars, to offset some of your upfront costs. You don't want to get in the position where you own these systems and you promise people you're going to maintain them for 25 years and then you cannot. Because I actually own a SunPower system at my house. Luckily, I own it. They just went out of business. So these things happen all the time. Last thing I'll say is EPC recruitment, management, and vetting is essential. You need to have really clear strictures on, particularly in places without net metering. How are they allowed to right-size systems, or how do you make sure they right-size systems? What sales practices and promises can they make? Are they allowed to use third-party sales orgs, et cetera? So, and again, I'm happy to be a resource in more detail.
Excellent. Thank you. Now we've got a few audience questions, just an invitation for others to feel free to submit additional questions, but maybe to change the order up. Lynn, could you say a little bit about how you went about the crowdfunding aspect of your financial stack? Did you use Raise Green in particular?
Well, excellent question. And yes, we did use Raise Green. Raise Green, for those who don't know, is a SEC certified crowdfunding platform that at the time, a couple of years ago, was the only crowdfunding entity that was really focused exclusively on climate solutions. And Raise Green essentially walked us through all the steps. We raised about $352,000 in debt from individual, I believe it was about 75 individual lenders. They're not investors. This was an interesting, Andy, you had mentioned, it was sort of midstream that direct pay came out. the same was true for us. We had, we were looking at crowdfunding to actually share the equity ownership of this community solar project, which is about a $3 million project all in. But then along came direct pay, and we thought, okay, well, wait a second, we can't give that up. Like, that's too good to be true. As Andy said, it makes the economics of the project much better. And so we shifted gears with Raise Green and said, all right, well, then let's raise debt, because the Climate Access Fund, the 501c3, has to be the 100% owner of the LLC that owns the project. And so we shifted to the debt side of things. And yeah, it was a great way to raise capital when there wasn't capital. It's below market. It's not as below market as the GGRF dollars will hopefully be, but it's attractive to private investors. I will say the SEC rules are extremely intense, and so it was fairly burdensome. I think doing crowdfunding for a small project, and believe it or not, 352,000 is pretty small for crowdfunding, at least in my perspective, is tricky, because it's just, you just have to judge the amount of time you're going to spend dotting all the SEC I's and crossing the T's versus the amount of capital it's going to get you, particularly now that we have GGRF. If we didn't have GGRF, this would be a no-brainer. I'd say absolutely crowdfunding is the way to go. If you're going to go crowdfunding, I'd be happy to talk about it. Raise Green was a wonderful company to work with.
Great. Andy and Roger, we have a few questions around the potential opportunity to expand this model to other use cases. So we've been talking a lot about rooftop solar or community solar. Have you thought at all about if this type of central third-party ownership could be applied to EVs, EV chargers, roof replacements, et cetera?
I have. Yeah, so I mean, some of you guys may be familiar that EV leasing has become a much more popular approach, namely because there's this odd loophole where the $7,500 tax credit for the consumers, I think it's the Section 30D, is very restrictive. You know, the car has to be made in the US, and there's also domestic content requirements. For some reason, those don't apply on the commercial EV credit. So if you're Kia and you lease the car to somebody, Kia gets the credit and can reduce the lease price. So the EV credit is available via direct pay. I had a question for Lawyers for Good Government, whether there's this very confusing sentence that Lawyers for Good Government interpreted it to say that a nonprofit that owns an electric vehicle of any kind, could be commercial or consumer, and leases it out to somebody else cannot claim direct pay. So that kind of seemed to put the kibosh on leasing. I am sort of, I mean, I can't really actively pursue this right now, but there is the possibility that we could do a car share model and claim the credit on EVs. I have to decide if I want to get into car sharing, of course. I don't know, does someone else know if the charging tax credit is available via direct pay for the EV chargers? I don't know if it is. And then the only other one would be a ground source heat pumps, because air source I don't think are eligible for the tax credit. But personally, I don't want to own heat pumps. Ground source or air source, that strikes me as too much maintenance. So right now we're just doing solar and storage on the leasing side.
Great. Maybe to close out, again, a question for each of you. What, if anything, could the broader community provide to you that you think would be most helpful in scaling this model? And I'll leave that open for you all to think about and jump in as you're ready.
Well, I'll just speak to that a little bit, purely based on our experience, which is that if what the IRA and the EPA say they want to have happen, which they do, which is that a lot of this funding, the GGRF money, goes to folks who live in historically disinvested communities and the whole Justice 40 concept, then there really has to be, I think, more of an understanding of the need of subsidized financing. And that doesn't just mean grants. It means if you're going to have a nonprofit take advantage of direct pay, that nonprofit somehow needs to keep its lights on. And I think a lot of the GGRF money is directed toward project financing and project grants, which is critically important. But if you don't have nonprofits or organizations to take advantage of direct pay because they don't have enough money, you're not going to have any of this work, right? And so we have been a little bit disappointed in the end result of the greenhouse gas reduction funds, CCIA, NCIF, and Solar for All, to the extent that the amount of funding available for operations is as limited as it is. And I think that's a real challenge. And I think that's a space where philanthropy absolutely can and should step in. The challenge with philanthropy is being a former vice president of a private foundation, I can say this, we love startups and we love projects. We don't love operating money. And so I think because now there's a lot of capital for project finance, we need to sort of shift that thinking a little bit and appreciate that there needs to be infrastructure in place with which to deploy that capital.
I would say the biggest problem with the distributed solar in the US is it costs too damn much. If you compare, for residential, the costs have not really come down because the soft costs are going up even as the hardware costs come down. And I think the average system in the US might be like $3 a watt. In Australia, it's like $1, $1.25. Don't quote me on that, but it's something order of magnitude that different. And so what happens in the US is that you are selling solar, whereas in Australia, in other places, people buy it. And obviously that's a function of a lot of things. It's financing costs, it's permitting time, interconnection time, it's the solar coaster of, boom bust cycles. And, but if solar were to cost $1.50 a watt, I mean, it might not even matter that you can't get the tax credit. And our borrowing costs wouldn't be so determinative of the savings that one could get. So there's not a way to wave a magic wand. I mean, like in Georgia, there are 94 utilities, EMCs, Georgia Power, and then municipals. They all have different export rates. They have different interconnection timelines and permitting timelines. None of them use Solar App Plus in terms of the jurisdictions. It's a hard thing to fix, but wringing out costs is key. And also, last thing to note there is like with Davis-Bacon, there's kind of a tension, right? We want to pay people well, but my guess is that's going to raise price per watt by like 30 cents at least. And at some point, you can't have everything. You can't have like export tariffs on Chinese panels and you want US, I don't know, I don't know what the right balance is, but costs have to come down.
Those have been great answers, and really, made me want to change what I was going to say also. But I absolutely agree. We have someone who full-time just works on getting municipalities to use Solar App Plus. That's key for us. And then our solar help desk, we document utility interconnection issues all over the country. And there are all these really cool technologies out there, just that so many utilities still haven't adopted, which is key for us. And the thing that I'll say that I think would make lives easier is just realizing that working with historically disadvantaged communities takes a lot of effort and is really complicated. One of the top positions that we're hiring for related to this as part of Solar for All is having navigators in all these communities where we're going to be operating, who are going to be talking to people and are going to be having those in-person meetings that are really, really important. So I just think, making sure that people realize that, right, the funding is not there and it does need to be supported by philanthropy. outside of these government grants, and also just making sure that we can drive prices down. I think all of these answers make a ton of sense. And also just realizing that the people don't just show up, and you really do need to have people working in the communities who are going to be able to build that trust.
Excellent. Well, Lynn, Andy, and Roger, thank you so, so much. I'm going to put the slides up just for our final minute here to note. Thank you all for participating in this webinar, all of our attendees. If you have questions, I said I would share contact information. My email is on the screen, as well as my colleague's Yuning Lu's. She is running our RISE cohort that I mentioned with the 11 communities across the country. The slides and the webinar recording will be posted on the same page that you used to register for this. You can use the QR code in the bottom left-hand side of the screen to access that page again. With that, thank you again to our panelists, to all of you for joining, and we are concluding on time. So thank you.